Welcome to This Explainer. Today, we're unpacking the wealth-building engine that historically beats 90% of professional stock pickers. Look, if you've ever wanted to understand the ultimate investing strategy, literally the exact framework used by millions of people to consistently build long-term wealth, you are absolutely in the right place. We're going to take all that intimidating complexity out of the stock market and just cut right to the core of what actually works. Today, we're getting the S&P 500 completely demystified.
I want you to picture something for just a second. Imagine owning tiny pieces of Apple, Microsoft, Amazon, Nvidia, Google. Capturing the value of all these massive tech giants, retail empires, and financial institutions, all with just a single, simple investment. It's like having a VIP pass to the biggest companies on Earth.
Sounds impossible, right? I mean, how could one single investment possibly capture all of that market power without you needing millions of dollars and a whole team of Wall Street analysts behind you? Okay, let's dive into this, because it is actually very real, and it is hands down one of the smartest investing strategies you can utilize. Over the next few minutes, you're going to understand exactly what this strategy is, how it works behind the scenes, and why so many long-term investors choose it to secure their financial futures.
Section 1. What is the S&P 500? So at its absolute core, the S&P 500 is a stock market index that tracks 500 of the largest publicly traded companies in the United States. But here's the thing, it's not just some random list pulled out of a hat. It is highly curated. To even get a spot in this index, a company has to pass strict profitability and liquidity criteria. So what this means for you is that instead of trying to pick and choose just one single company to buy into, and just crossing your fingers hoping that that one company succeeds, your investment actually follows the overall performance of hundreds of the most dominant businesses in the world.
And this brilliantly illustrates a really helpful way to think about it. The S&P 500 is essentially a snapshot of the U.S. economy. And the true beauty of this snapshot, it's completely self-cleansing. As the economy changes, like say with the massive rise of AI we're seeing right now, the index automatically updates itself. If a company fails or shrinks, boom, it drops out and is immediately replaced by a new winner. You aren't just looking at one narrow sector, you're literally holding the real-time economic engine of the country.
Section 2. The companies inside.
I mean, we are talking about Apple, Microsoft, Amazon, Nvidia, Meta, Alphabet, Tesla, Visa, JP Morgan Chase. The sheer volume and variety here is just staggering. When you invest in a fund that tracks this index, you're grabbing a piece of every single one of these global giants simultaneously. And here's a really fantastic insight for you. While this is technically a US index, these juggernauts earn massive amounts of their revenue overseas. So you're actually getting incredible international exposure just by holding this one domestic fund. How cool is that?
You also get incredible sector diversity. You've got technology, sure, but also healthcare, finance, consumer goods, energy, and so much more, the whole shebang. This ensures your investment isn't relying on just one single sector to succeed, which gives you a remarkably sturdy, resilient foundation. Let's say the tech sector has a rough quarter. Well, healthcare or consumer goods might be booming right at that exact same time, balancing out your portfolio.
Let's move to and see how this builds in Section 3, how the index works.
So every company in the index has a different weight, and that weight is based strictly on its market value. Basically, the massive companies at the top of the food chain have a much bigger, disproportionate impact on the index's overall movement compared to the relatively smaller companies down at the bottom of the list. It's definitely not an equal 500-way split. Size absolutely matters here. Because of this market value weighting system, those heavyweights carry immense influence. You've probably heard people talking about the Magnificent Seven tech stocks, right? Well, right now, the top 10 companies alone make up over 30% of the entire index's total weight. It's wild. When these titans have a great day, report strong earnings, and their stock prices shoot up, the S&P 500 as a whole usually rises right along with them. They literally move the needle for the entire index.
Section 4. Why investors love it.
Now, what's really interesting about this slide is the massive appeal of the S&P 500 really comes down to 3 sequential, incredibly powerful wins: diversification, long-term growth, and low effort. These 3 pillars combined are exactly why this is a favorite, rock-solid strategy for long-term investors everywhere. Let's look at them one by one.
First up is diversification. Instead of putting all your hard-earned money into one single company and constantly sweating, worrying that something might go wrong with that specific business, your investment is instantly dispersed across 500 of them. You are casting a massive net, which is a brilliant, proven way to mitigate risk.
If one company gets hit with a massive scandal and its stock plummets, it's okay because the other 499 companies are there to absorb the shock.
Then we have the final two wins. Historically, the S&P 500 has delivered remarkably solid long-term returns, averaging around 10% annually over the long haul. In fact, Warren Buffett famously made a $1 million bet that a simple S&P 500 index fund would easily beat a team of high-fee, elite hedge fund managers over 10 years. And spoiler alert, he won that bet easily. And honestly, the absolute best part is that it's incredibly low effort. Think about the active traders out there wasting hours and stressing out, staring at complex charts all day, compared to an investor just relaxing in a hammock who owns the S&P 500. The index does all the heavy lifting for you.
Section 5. How you can invest. But here's the catch. You actually can't go out and just buy the index directly. The S&P 500 is simply a mathematical measurement. It's a list maintained by a company. So the crucial point is, to get in on the action, you have to use specific financial vehicles designed to mirror that exact list.
Instead of buying the index directly, investors use exchange-traded funds, or ETFs, that are precision-designed to track the S&P 500. Funds with ticker symbols like VOO, SPY, and IVV are built to mirror the performance of the index exactly. It's honestly like unlocking a secret cheat code for the stock market. By purchasing just one of these ticker symbols in a standard brokerage account, you instantly achieve the work of thousands of trades and gain that beautiful, diversified exposure to all 500 companies in one fell swoop. Which leaves us with a final, very important thought. We've seen how simple, diversified, and powerful this strategy is. It takes the guesswork completely out of the equation. Thank you so much for joining me for this explainer. The vehicle for long-term wealth is already built and just waiting for you, so what's stopping you from taking the driver's seat? Keep learning, keep focusing on the long term, and I will see you next time.